Welcome, everybody. Before we get started, I just want to let you quickly know that we are recording this webinar and it will be made available on the Highstead website along with the previous 2 sessions in this series. My name is Tara Whalen of the Highstead Foundation, and I'm excited to welcome you to the 3rd session of the Conservation Finance Learning Lab, The Power of Debt, Borrowing Money to Save the World. I want to thank you all for joining us today and thank my co-host Leigh Welton and the Conservation Finance Network team for their partnership in building and delivering this series. And before I turn it over to Leigh, I want to acknowledge the team that has worked so hard to bring this series together. From Highstead, we have Jody Kalogi, Jean Ammermoller, Tawassert Vaughn, and Fiona Lunt, who have been working behind the scenes on communications and tech, and Jackson Moeller from the Conservation Finance Network, who has worked to plan and design this course, as well as bring together all our speakers for the series. And with that, I'm going to introduce Leigh Whelpton and ask for her to introduce our panel and tell us a bit more about what we have planned for today.
Thanks, Tara. Thanks, Highstead. Thanks, everyone, for joining us today. Here we are, part 3 of the Learning Lab series, The Power of Debt. And an unambitious title we gave it, Borrowing Money to Save the World. Thank you for laughing with us. I'm Leigh Whelpton, Director of the Conservation Finance Network, and our fundamental business is to expand people's capacity, confidence, and connections to execute on conservation finance approaches. We bridge various sectors, public, private, nonprofit, philanthropic, to help people find the capital they need to advance the pace and scale of their own efforts. And a reason for excitement today, one of the most accessible but still underutilized tools in the arsenal of the conservation practitioner is the effective use of leverage, also known as debt, also known as borrowing money, sometimes bridge finance, or even colloquially, as you'll hear it used today, OPM, or other people's money. I want to share a quick word or echo Tara in a word of thanks to the Highstead team and to my colleague Jackson. And of course, all of you for taking the time out of your busy schedules to join us today. Everyone here is likely joining out of some sense of frustration or some challenge that they're up against with finding financial resources to support their work. Certainly, when we asked you all to register for this session and we asked for your greatest frustrations and challenges, we heard plenty, all of which that really track with what we observe: lack of funding sources, lack of leverage, lack of time, all the things that keep us from going on to do great work. We hope this particular Learning Lab series, this session today, provides some practical insight and guidance, especially for you to try something new, whether that's picking up the phone and calling someone, starting to build a relationship, having a different conversation with your board, something that helps to move your work forward. So practical insight, plenty of follow-up, that's the goal for today. I do want to introduce our speakers and panel for the session. We have our trail guide and guru, Reggie Hall, Director of the Conservation Loan Program at the Conservation Fund. Reggie works with land trust, community partners, and government leaders nationwide to save special places outdoors. He's been able to come to the assistance of many a land conservation partner in urgent need of capital. In at least one instance, I believe closing a loan to save a priority acquisition in as little as 3 weeks. When not saving land, he's out experiencing it. You'll catch him on a bike, you'll catch him in running shoes, or sometimes bundled up in a wetsuit surfing the New Hampshire coastline. Next up, we'll have Kristin DeBoer, borrower extraordinaire, if I can give you that title, Kristin. Executive Director of Kestrel Land Trust. Kristin has been working with Kestrel and in the environmental field for 30 years. She served as the Executive Director of Kestrel, which serves the Connecticut River Valley of Western Mass since 2006, and has really led and spearheaded the organization's growth from being an all-volunteer group to a professionally staffed land trust of 9. We've been lucky enough to host Kristin's staff in our Conservation Finance Bootcamp and are in awe of their effective use of debt to conserve and protect priority parcels in their operating area, which we're excited to hear more about today. And last, but certainly not least, We have expert leverager, which is the name I'm giving you, Cam Tredennick, principal with TTCT Land and Water. As an executive director, project leader, and attorney, Cam's led conservation transactions resulting in conservation and restoration of over 75,000 acres, exceeding 100 million in the value of those acquisitions. He's employed a variety of public and private funds, partnered with Native American tribes, universities, corporations, NGOs, you name it, to achieve conservation gains in places with great need. And we'll say Cam's experience with borrowing in particular runs the gamut of simple loans, pretty straightforward bridge finance, to some of the most complex and advanced applications of debt finance we're aware of. All right, so that's our lineup for today. And in terms of today's session, we really want to embolden you, the participant, to consider the use of debt finance before there's an urgent need or impending fire drill. We all use debt in our personal lives to finance our educations, to finance our cars, to finance our homes, and a whole lot more. But for some reason, when it comes to our projects and transactions, many of us, or in some cases our boards, just don't consider how borrowing money could similarly support and enable our work. In the prep for this session, we were reminiscing, Reggie and I, back to a survey we did with the Land Trust Alliance in 2013, which found a lack of confidence was really one of the principal things holding many practitioners back. And even if a land trust staff was financially savvy enough, the board may be adverse to the perceived risks of debt financing. This led us to the conclusion, and some survey findings corroborated this, that direct technical assistance and coaching offered one of the best pathways to adopting the tool. We've done a whole lot of different types of borrowing money sessions over the years, many of which have been focused on the nuts and bolts of borrowing. But today we're going to try something a little bit different. We're gearing the session a little bit more as a confidence boosting session than anything else. So not exactly how to borrow money, but why you're already ready to consider borrowing today, and why not to wait until tomorrow to speak with your colleagues or board about it. This also tracks at a time when there are a number of new borrowing programs and facilities emerging, and we really want you all to be poised to take advantage of them where appropriate, to capitalize on these new finance facilities or authorities, and to increase the capacity and impact of your organization. So today's a little bit more about confidence than about know-how. And we hope you'll walk away a little better acquainted with how to think about folding debt strategies into your toolbox. So Reg, I'm going to hand things over to you to get us started, and I will give you the obligatory 2-minute warning when we're ready to move on.
Okay, thank you, Leigh. And I will, let's see, start sharing my screen. So really, I'm going to be just kind of setting the foundation for our discussion, really looking forward to the panel side of things, because we've got such a great audience and a real range of experiences. So without further ado, I'd be remiss talking about borrowing money before, without talking about alternatives. Certainly patient seller, flexible funder. There might be a conservation buyer or an angel donor out there that could pre-acquire or help you achieve your outcome so you don't have to borrow money. They give you the opportunity to give you the time that you need to put together the funding. Private sector partners out there are growing in capacity, in sophistication when it comes to conservation. So certainly some viable alternatives out there, depending on your project. And then also the potential, if you're a local organization, there might be a regional, state, or national group that shares priorities and want to see the outcomes achieved. So they might be able to step in and partner with you so you avoid taking on debt. Really, of a lot of the financing and the debt for conservation is bridge financing. And what I mean by that is specifically filling a finite time gap or a funding gap. There are certainly longer term sources of debt out there that have been used successfully, and they're available, but you certainly, depending on your experience level with using other people's money and borrowing it, you certainly want to consider the length of time that you've got that money. Usually longer term loans, they may be risky, as far as what happens out there. Organizational priorities change, funding priorities change. People come and go from a staff perspective, and expertise change. And so, sometimes longer term loans, while great and they help you achieve an outcome, you just have to proceed with caution and go in eyes wide open. So choosing a lender, there are so many different types of lenders out there that are financing conservation. I created a little matrix here and just captured a few of them and some considerations. So, on one axis, we've got the interest rate, i.e. the cost of capital. On the other axis, in this particular instance, the time it takes to get a loan. Things to consider. Sometimes it might take a few months to secure financing for your project. Other times it may take a few days. It really depends on who you're working with, and the time frame and the pace of your project, and how prepared your organization is for a project.
Hey, Reg.
Yes.
You may be advancing your slides, but we're still seeing the cover slide.
Oh, really? Okay. Interesting.
Are you in presenter mode?
I am in presenter mode.
Okay, we're not seeing the presenter mode. We're just seeing the whole slide deck.
Let's see. Should I just do it? Can you see this?
Yes.
Okay. Let me try starting here. Can you see that? Choosing a lender?
We can. It's still not in presenter mode, but what you're doing is working. So let's run with it.
Okay. Sorry about that. Interesting technological issue. How about that? Did you see a change?
No. Sorry.
Okay. Well, then I'll just scrap the PowerPoint. No big deal. Let's see here. I guess, Kristin, if you're using PowerPoint, prepare for this during your session. Now I can't get out of, there we go. Okay. So
we can see that if you want to try continuing.
Okay. Yeah, well, it's an animation. So, certainly I was talking about the matrix, time it takes to get a loan. Another thing to consider is how hard is it to get a loan? With particular types of lenders, they have different levels of risk, different collateral requirements. And so there may be an incredible number of hoops to jump through to get to the end goal of securing the financing. Jody, are you taking over? Or are you able to?
I did, Reggie. Is this the right slide?
No, if you could advance a few slides, keep going. Okay, and hit again. Great. Okay, so there's risk aversion and collateral required. Again, just something to consider. If you could advance again. Degree of difficulty, just hit on that. Again, really, once we end this session, going back and talking to potential lenders, whether it's a bank, local foundation, conservation lender that you're aware of, and just understanding their parameters and their operating guidelines before you get to your crisis situation. Oh my God, we need financing. Just so you're prepared with a strategy and a game plan of what you need to do. If you could advance the slide, that'd be great. And finally, mission alignment, thinking about your source of funding and how the lender and their mission may align with your own. And this is particularly important when things might not necessarily go as planned. A conservation lender or an individual donor may be really interested in seeing the conservation outcomes. They understand what a conservation easement is or some other conservation funding source. The wheels of bureaucracy at the grant maker are turning a little slower than we all anticipated, and they might be more willing to, say, issue a loan extension to give the funding time to come through. Whereas a bank or a more traditional lender, maybe a little bit more rigid, might not be as flexible. And so again, just an important consideration when thinking about your sources of debt. If you could advance the slide, that'd be great. Just made this map, some but not all loan programs for conservation out there. There are a few national ones. There's the Conservation Fund, the Access Fund, the climbing-based nonprofit or climbing-centric nonprofit has a loan program. Also, Norcross Wildlife Foundation. They have a great program. I think loans up to $250,000, 0%. For up to 1 year. So, and there are other regional loan programs. I understand there's several that are in the works, whether it's the Delaware River watershed or elsewhere. So looking forward to updating this map as it continues to evolve. If you could advance to the next slide. So best practices when working with a lender, communicate early and often, as I mentioned. Great to reach out to us lenders before you actually need us, just to establish the relationship. Ask for help. Some of us lenders can provide technical assistance or review draft documents or give you ideas of what it will take for you to be bankable. Think like a business. Not only have your loan repayment strategy, but also have a backup plan and maybe a backup to the backup, just in case things don't go well. And also going in and talking with a potential lender and anticipating their questions. You know, how much do you need? For how long? What's your potential collateral going to be? How are you going to repay this? And then importantly, you know, when you close on the project, you secured your financing, you've achieved your goal, tell a story. Get those stories out in the newspapers, on the internet, social media, what have you, and use that opportunity to thank us lenders. It goes a long way, not only for the existing project, but also down the road. And keep us updated, especially as it relates to loan repayment. You know, oh, yay, we got the grant, or no, the grant didn't come through, but we're pivoting to plan B or plan C. You know, we might be able to help. We might be able to give you some pointers or give you some ideas on other funding sources or ways to improve the project when things didn't go necessarily according to plan. If you could advance the slide, that'd be great. So, but, you know, why borrow money? You know, why go through this trouble? Why put your organization at a bit of risk? You know, what's really behind what are the driving motivators here? First and foremost, accelerating outcomes. You can fill that time gap. You can close on tomorrow's park at today's price. You can meet the landowner's needs and bridge that time or funding gap. You know, the grants have been awarded, or you're bridging a capital campaign, you got a bunch of pledges, and you just can't wait for the actual cash to be in hand. Borrow money, bridge it. You also might save money. You know, interest rates are still really low. They're going to start going up, but there's an opportunity there. You might have money on your in your organizational asset base that's earning whatever 6%, you know, wherever it's parked in a money market account, in a bond, or something else. Borrowing money at 3%, 2%, 4%, whatever. Your own assets are still generating interest. You're still you know, keeping that powder dry. And it might be a shrewd move. You're net plussing still a return to your organization. You're also limited resources, whether it's financial resources, perhaps even capacity resources, and you're growing internal expertise throughout the process. And in so doing, you know, when you're out there telling your story, you're improving the reputation of your organization in the community. You know, by qualifying for debt, that really says a lot about your financial capacity, your organizational operations. It's almost like a good housekeeping seal of approval if those things are still around. And then there are also a tremendous amount of fundraising opportunities throughout the process, whether it's before you actually need the loan, prior to closing, maybe it's during the loan repayment, or maybe even after the fact. Donor cultivation opportunities abound. Happy to chat about these when we get to that point. But for now, I want to turn it over to Kristin and have her tell you a bit about what Kestrel's been up to and their organizational evolution and experiences with debt.
All right. Hi, everybody. Can you see my screen okay?
Yep, coming through just fine.
Okay. Well, thanks for having me. This is a treat to be on this call with just a dozen people, although I know there's hundreds out there. We can't see you. The Conservation Fund and the Highstead Foundation have really been instrumental in helping Kestrel Land Trust grow as an organization and have more impact in our service area. So I'm really grateful for the opportunity to be on this panel and share a little bit about what I've learned over the last decade or so in lending, taking out these loans and making things happen. So I'll just start by describing where Kestrel started. It was a small volunteer organization for many years, founded in 1970 in Amherst, Massachusetts. Really was a great little organization, but was thinking on a small scale, really just mostly about one town. Most of those projects were kind of free projects, you know, if there was some conservation value left over after a little development went in. And we were protecting like 80 acres a year for the first 30 years. So not a huge impact, but good behind the scenes bones, I would say. When I came on the scene in 2000, I started as a volunteer on the board. And, you know, honestly, it was a little confusing what they were all talking about, all these landowners, and just trying to figure out what their scene was. When we started branding a little bit later on, someone told me that everyone thinks of Kestrel Trust like a bunch of white people in sweaters. And I was like, oh, that hurts. How can we have more impact? How can we grow the importance of land conservation in the Valley? So our quick trajectory of growth basically was from a small volunteer organization to a proactive professional organization. We went through a merger in 2011. We went through accreditation. And we went through several bridge loans, and there's lots of things that enabled us to grow along the way, but definitely the bridge loans built our capacity to do more and create more visibility. And so I'll just share a few lessons that I learned along the way, and hopefully this will advance for me. Do you see the boardwalk? Yes, okay.
Let me see us.
So first thing is borrowing money builds courage. So this was one of the first projects that Kestrel was involved with the Conservation Fund. It was a pre-acquisition of $1 million project, a parcel of land for the U.S. Fish and Wildlife Service to expand the Silvio Conti National Wildlife Refuge. And why did we need courage to do that? It was because it involved going up against a developer. This area would have been full of subdivisions had it not been purchased for conservation. We had to compete for the land on the real estate market, and the only way to do that was with the purchasing power that was provided by the Conservation Fund. So it enabled us to not shy away from the really difficult projects, which is often when land goes on the market. It also built our courage to think bigger as an organization and partner with bigger entities. So previously we had been focused mostly on a municipal relationship with the towns that we served. But as we started taking out bridge loans and pre-acquiring land for conservation, we were able to access larger state grants. Massachusetts has a really great program called the Landscape Partnership Grant, which is a minimum of 500 acres. We did a few of those, and that was only possible through the bridge loans. We also worked with the Forest Legacy Program and have done several 1,000-acre projects now in a row, which enabled us not only to partner with Forest Legacy, but also attract bigger grants for projects along the way. So, you know, when the landowners can't wait, the bridge loans make a difference and give you the confidence to move forward. So I think courage is a big reason to engage in lending and borrowing rather. Okay, how does it inspire creativity? Reggie's presentation mirrors a lot of what I'm sharing with you because he's taught me a lot about how this all works. And thinking with those backup plans, I think is the big change in how to do projects from a small volunteer organization to a professionally staffed one that's really trying to be proactive. So it's about that plan A, your ideal source of funding. What do you really want this to be? Maybe it's a state park addition, but maybe there's a plan B where there's a private landowner who's buying the fee interest and you're getting a CR donation, or there's a plan C, which involves fundraising with the community, or finding that angel donor to come for a leverage grant or a challenge grant. So just getting in that mindset of thinking creatively about each parcel of land, each priority area, it could be one thing, but being more creative about why you're protecting it, who you're protecting it, and how you're protecting it, I think makes a huge difference. And I can say right now I'm involved with a project to protect 220 acres in a high priority area, and I'm already on to Plan C, and it's enabled us to be tenacious and stick to the program and make sure the land is protected. So, I think just practically, I'll say that, when I'm in a project, I'm not only looking at the maps and the conservation values, but thinking at a financial level about projects, working with those Excel budgets every single day to work the numbers to make sure it works has made a big difference. And then it has encouraged collaboration for us. Borrowing money has encouraged collaboration because we're able to help partners that may not have the expertise or the capacity to think about complicated projects, to think about pre-acquisitions. A couple of the cases I'm picturing here, most recently, our bridge loan from the Conservation Fund was for the food bank farm, which involved a $2 million purchase with multiple parts. Some of it went to a conservation area, some of it went to a private farmer, and the bulk of it, 140 acres, went to the food bank to create a farm that's dedicated to producing local food for the people who need it most. And so that really leveraged the power of money to make good happen, not only for the land, but for people who need the food. And similarly, we've started partnering with the city of Holyoke, which is an urban area in our region. The Norcross Wildlife Foundation, in this case, has given us a grant to expand an urban forest there and start to think about how can we revitalize a park that serves the people of the city more closely to their homes than some of the other parks in the valley. And then our third partnership that we're looking at using bridge loans for is with this group, All Farmers, that serves refugee farmers in the Connecticut River Valley. So I'd say if you're borrowing money, it expands your capacity to be a good partner with lots of different groups and not just think about your own land trust, but how you can be of service to the community. And then finally, borrowing money has definitely built our capacity. I think thinking like a business, as Reggie said earlier, has been a huge advantage in thinking about how to grow our organization from less than 1 staff to almost 10 staff now in just 10 years, and thinking about each of our staff time as part of the value that we're adding to a project. I can remember early budgets where basically the 2 lines were acquisition and maybe appraisal, and every project that we were doing was not leaving us in a better financial shape than we were when we started. And so now we really look at every conservation transaction as an opportunity to build our financial strength so that we can build momentum, so that we can pay the professional staff that make the projects happen, and so that we can build the visibility that we need in the community to really ensure that we're around for the long term, to not only conserve the land, but care for it and connect people in meaningful ways that improve their lives. So we've grown because of a lot of great reasons, but mostly I would say because we're able to think like a business and think financially instead of just about the land, which is sort of why we're all here. But the numbers matter a lot, and it's enabled us to, I think, become a more relevant, professional and proactive land trust in the Connecticut River Valley. And then finally, I'll just leave with a few thoughts about Reggie's talk, the importance of building that relationship of trust and being in contact before the urgent need comes up. It's similar to the small bank that you might be in relationship with around your house, house improvements that need to be done. There's just a level of trust there, and because there's the relationship, it gives you the confidence to move forward more quickly when the time comes. And so I'm really grateful to Reggie, to the Conservation Fund, also to Norcross and other individuals that have lent us money to help us grow and help us have a greater impact on the landscape and the people who live here. So thank you. I'm looking forward to our Q&A, and I will hand it over to Cam.
Thanks, Kristin. And before Cam gets going here, a quick reminder to everyone who's listening in. Please go ahead and add any questions that you have, any dynamics that you'd like us to lean into a little bit more fully, perhaps, for the panel discussion. We're going to give Cam his 10 minutes, and then we're going to get right to it. Cam, over to you.
Thank you very much. Those are two fantastic presentations, and I am looking forward to a discussion afterwards. I'm going to try and keep this pretty short. Originally, I was going to speak about several different lending sources that I've used in my work, but I think I'm just going to limit it to one, and that's the state revolving fund that's held by EPA and authorized under the Clean Water Act. And my experience with it was with Western Rivers Conservancy when we did a land transaction on the north coast of California, along with the Yurok tribe. Purchased 47,000 acres. It cost about $60 million. Took about probably 12 years to close that transaction from originally signing to the close, which happened in phases. And the seller was Green Diamond Resource Company. And the deal was really a result of many years of discussions between Green Diamond Resource Company and Yurok. And when they finally came to an agreement to actually make the transaction, they looked for a nonprofit that could help, and Western Rivers Conservancy presented to them, and then became that go-between because of the final work that Western Rivers Conservancy had done and other projects with Green Diamond Resource Company. Yeah, I'm giving you that background because the nature of the transaction was the big conservation gain was a stream, a tributary to the Klamath that is called Blue Creek, and it had tremendous spiritual and cultural value to the tribe, and also was essential to the fish species, the salmon swimming up the stream. But to get there, the tribe had this long negotiation with the Green Diamond Resource Company, and was in a position where we had to first purchase properties upstream from Blue Creek, which had lesser conservation value. They had value to the tribe, and they did have conservation value because it's along the Klamath and pretty much everything there does. But for that to be a sell to the agencies, the granting agencies, to spend limited grant money on something, and understands California, and they got a billion different choices and lots of money, but still there's a lot of competition for the dollar here. There was no way they were going to start off with that phase, what we call the phase one property. And I'm going to keep going because the important thing is you understand the details of the loan. So we were faced with a situation that we really didn't have anything, in order to get to the real meat of the product, we had to get through the rest first. And the tribe was telling us they weren't willing to borrow in order to pay for it. So we had to pretty much find a pretty extraordinary source in order to get this first part done. And the Conservation Fund had used the state revolving fund down south of us in Mendocino County to do about a $25 million loan on an easement, I believe. And I saw that and wanted to sort of essentially duplicate that process. And what I discovered while I was doing it was pretty good. I mean, it ended up with a 0% loan for the full $18.75 million purchase price to the tribe, and which they would pay back using two sources, carbon and receipts from harvesting on the land. So the source of that was the Clean Water State Revolving Fund, which is the largest fund dedicated to the purpose of addressing water quality challenges under the Clean Water Act that exists in the country. It's been funded since 1987, about $145 billion, which is appropriations to the state. Understanding this is a revolving loan. So that $145 billion out there is still out there someplace. It's either in a project, it's been repaid back to the state, or it's available for further allocation. Additionally, the states have to match, so they're throwing money in there too. So understand you're talking about quite a few dollars here that's available for the purpose of Clean Water Act provisions. Now, the Clean Water Act has two primary objectives, right? One, non-point source pollution, everything that comes out of a pipe. And two, well, I'm sorry, that's point source solution. Point source is everything that comes out of a pipe. And then non-point source, which is the stuff that you do. And that's, anything from ag runoff, urban runoff, soil depletion, forestry depletion, anything that's in a state water plan, from endangered species to habitat protection of pretty much any sort. The fund, Congress treats those two things equally. So in other words, the legislation that set this in motion does not see a difference between the point source and the non-point source projects. However, since 1987, 96% of the money has been used for point source projects and only 4% for non-point source projects. The fund is increasing significantly over the next 4 or 5 years. And there's a push to start looking more at non-point source projects, which I would urge you to think about. By law, the rate can go no higher than 1/2 the general obligation bond rate of a particular state. In the Yurok tribe example that I just put out there, we had a 0% loan over 25 years for the full purchase price. It was $18.75 million. The purchase price was $18.75 million. It essentially amounts to, in that particular case, free land. They're paying back a loan for the trees. And then nowadays there's a 30-year, in California at least, there's a 30-year repayment process. You can go to 20 years if you're and get a lower rate. The rate in California right now is 0.8%, and which is a pretty good deal at this point. So there's two things you'd have to show that your state. In our particular case, it's the California EPA, state water boards. But whoever's implementing the Clean Water Act in your particular state, there's two things you need to show them. One is there a water quality benefit, and that's always going to fall into your purview. So for example, if you're working on if you've planned out your acquisitions, you have a region you're working on, and say you have 10, 15, 20 parcels or different ownerships you have to acquire over a period of years, the conservation value of those parcels. They fit under the Clean Water Act. So your justification to the water board is in that plan. And if it's consistent with the state water plan, you've checked off box number 1. Box number 2 is repayment source. You have to figure out a way to pay it. It can't be a bridge loan. So you can't say to the agents, to the water boards, I got X agency over here ready to give me a grant in 3 or 4 years. Can I bridge it? And I promise you, I'll pay you back. There's got to be actually a receipt source. And that's what hangs a lot of folks up. because you don't have a lot of those available to you as an NGO. But things have changed over the past few years. In the Yurok example that I gave, we had the benefit of transferring over to a tribe which has natural receipts built into it, the timber harvest and carbon. Carbon was young at the time. It's a more secure funding source now. Back then, it was brand new and as a market and brand new in California. As a matter of fact, there was a proposition on the ballot which would have essentially eliminated it. So we had to work through that with the water board, but eventually that worked out. I mean, the proposition went down and we were able to move forward.
Cam, about a 1 minute warning here.
All right, great. And then, so I'm gonna conclude it by, by just saying that that's generally the outline and the benefit for you. I've spoken mostly from this. I think we're going to put a link up there from a document EPA put out, which is a state revolving fund best practices guide for financing. I think we're going to try and get a link in the chat if we don't already have it. And I would urge you to look at that. And if this has appealed to you, I'm interested in seeing more of this, and I'd love to be able to work with you to investigate in your particular state. The California Water Board is wonderful to work with, and they really are looking for opportunities to put this out, and it really fits into most of your missions, I'm pretty sure already. And the key thing would be partnering so you can find receipt sources to pay it back. And I'm happy to engage in that more when we talk as a panel.
Thanks, Cam. I'm going to invite the panel back up. And I put this in the chat as a friendly reminder. Our last session delved into SRFs in some detail with Allison Souders from EPA. So if you missed that session, I would take a gander back at that recording. Lots of resources shared as well during that session that we're populating back into the chat box here. But first, let me just kick off our panel discussion here. For really any of you, but Reggie, I'm going to borrow a cute quote from our prep session. Besides getting the deal done, can you talk a little bit more about those side benefits or what Reggie would call the extra milk on your whiskers?
Yeah, well, I mean, there's so many potential benefits out there. I guess first and foremost, and I mentioned this during my little talk earlier, is just cultivation, support networks, growing your donor base, your potential funders, and there are all sorts of new tools, and I'll skip ahead a little bit, but one of the really interesting trends that I'm seeing out there in the borrowing space are land trusts working with what are called impact investors. And whether that's a formalized legal relationship like a private placement note or an offering similar to what Washington Agricultural Land Trust has done with their farmland note program, or perhaps a more informal, just an individual lending money to their favorite land trust, or a group of individuals lending money to their favorite land trust. And so, I mean, God, talk about donor cultivation, and there's some, Leigh, I think you guys did a really nice article profiling the farmland note program up in Washington and all the benefits there, not, a bunch of the quote unquote investors in the project weren't members or former donors, just a new way to engage and cultivate and grow your network. Then there's also, I mean, levels of sophistication and the story and getting out there amongst the community, right? I mean, Kristin talked a little bit about her project with the food bank and just the profile of the organization in her community, really rises above. And I think this is important for organizations because if you think about all of the donors in your region or in your town or your state that are supporting nonprofits, effectively think about it. It's like, okay, every family might have $100 that they give away to charity. And the land trust or the conservation community is competing with the volunteer fire department, the library, the humane society, the alma mater, what have you. They're giving their money to causes that they care about. And, it's really hard to argue with not caring about clean drinking water, or with the food bank, access to healthy local food. And really that's powerful. That's a powerful message. And using debt to advance your cause and collaborate and grow courage and all of those wonderful things, is a huge opportunity to grow the profile. I mean, there's so many benefits. I could talk forever, but I'll stop and see what my fellow panelists say.
Yeah, well, I think it's about visibility. I mean, I can tell a quick story. I was actually just reminded by Peter Howell, who's in the audience, that our first loan was from OSI in a small farming area, historic but small, called the Great Meadow of Hadley, Massachusetts. And kind of in our volunteer reactive way, we would have just done that project quietly without telling many people about it. Or maybe we wouldn't have done it at all, because in that case, it actually involved taking a property off the market that was being sold as 3 house lots. And so we took out a loan to buy the land. And instead of just doing that one thing, we really shined a spotlight on this whole area. We started doing a 5K for farmland event, which brought a lot of visibility. And this one donor, I remember coming forward with $1,000 gift. That was about 15 years ago. Well, last month they passed away and left us $1 million bequest. And it was all about visibility and creating that level of concern, not just attention from our land trust, but really the community around that one area of farmland. So I think that, bridge loans are kind of the first step, but the visibility, the PR needs to follow, and meaningful impact, of course, is, it has to be authentic. Another example is on the Mount Holyoke Range in Massachusetts. We were approached by an angel donor who had given us a gift of $300,000, which at the time was huge for us. But instead of sinking that $300,000 into just one project, we decided to leverage it with state grants and partnership with the state park, a conservation fund loan for several of the projects. We put together about 12 parcels. It ended up being a $3 million project, and we conserved 1,000 acres of land on the state park. So, and then that led to another project a few years later. So it's all about momentum and visibility, in my opinion. And the bigger things we can do, the more people are going to be excited about land conservation.
Yeah, and I would add leverage. I mean, that was mentioned, and it's just in the example I provided, it was the key leverage piece of leverage we needed in order to get to point B. And I think the land trusts a lot of times are focusing on the full protection of a property, and sometimes what you want to do is you want advanced protection. And so perfect being the enemy of good, and loans tend to be able to provide that opportunity. If you have ag land, more and more conservation on ag land is desperately needed. The emergence of regenerative ag as an option is an example of something that you're still gaining receipts out of these properties because you're still farming them or you're still cutting down timber. But the advancement in conservation is what you're looking for. And loans are a great way to achieve that. And then, like they said, it attracts partners. Because you have to pay it back, you've got to find somebody who's willing to work with you who can pay it back. And odds are they have an interest which is aligned with yours. It'd be a water agency, a district, or a government. And there's nothing but good in reaching out to those folks.
Really great insight, and a hefty bit of inspiration there, Kristin, for what that leverage can do to level you up. I want to touch back on this issue of board hesitancy and some of the first steps or issues you can navigate in trying to find a champion at the board level, in trying to get over some initial hesitancy, how you breach the topic, how you really get the borrowing conversation into the board meeting, into the board discussion before you've got that urgent need that's going to slip through your fingers.
Well, I think urgency is a great tool. So although it'd be great to have that conversation proactively and in advance, I think a lot of what motivates board members is real threat, right? So, you know, this property that we acquired, we call it Champagne. That was the landowner's name. You know, that was going to be 4 giant estate lots with McMansions, and it just turned people's stomachs. And so it was sort of a small bridge to the bridge loan because the threat was so large. So that's not the answer that you were looking for, but I do think threat makes a difference. And if you can demonstrate that a bridge loan will enable a land trust to act quickly where otherwise, literally, we would just have given up had we not had a bridge loan.
Well, we're also about pragmatism. So if the urgency is what's needed to actually get the board across the finish line for a decision on taking on debt, so be it. Reggie, you've talked to a lot of different groups at various stages in their borrowing trajectory. What say ye about kind of board hesitancy and overcoming it? Or using the
topic
as a tool?
Yeah, fascinating. Wish I had been a psychology major in college. You know, it's really interesting working with executive directors and other staff, helping them to navigate the discussions with their own boards about potentially taking on debt or, you know, subjecting the organization to risk, you know, from a lender. You know, and it's really interesting because you think about it, we use debt so frequently in our own personal lives, credit cards, car loans, home mortgages, so on and so forth. And then folks get on a board and fiduciary obligations and responsibilities flip on, and oh my God, we can't take on a loan, can we? You know, it's interesting. I think it certainly can be overcome. And I think those instances, as I mentioned, bridge financing, where it's shorter term, loan repayments are fairly secure, like you're bridging a pledge from a foundation or a grant that's been awarded, but it's just not in hand in time for the closing, and maybe it'll be in hand 3-6 months later. And you're just bridging you're doing a bite-sized chunk, and also potentially working with a mission-aligned lender. Maybe it's a foundation and a program-related investment. Maybe it's an individual. Maybe it's another conservation lender. Those all help to, I think, soften the anxiety a little bit. Yeah, and you know, and then there are those instances where, and to kind of tie in a couple of different points, you know, those instances where an agency or a town or a city approach your organization and ask for help, right? And, you know, one instance that comes to mind in Texas is, you know, a city approached their local conservation group, small group, to pre-acquire a bunch of upland for a future park, but the primary reason was for flood mitigation and control. And the city was it was the first project, first state water revolving loan of its kind in Texas for non-point source for conservation. And, you know, loan to the city was a loan repayment for our borrower. And, you know, a good portion of the loan was forgiven, and it was at a super low interest rate. So the city was excited. They were acquiring tomorrow's park at today's price, but the land trust was motivated to take on this risk because they were like the heroes of the community in preventing future flooding.
And a lot of times you can offload risk too. I mean, it's, you know, things tend to, you know, one of the sources I didn't talk about was new markets tax credits. And because it's too complicated to address here. And if anybody wants to talk to me about that sometime, just send me an email. But well, one of the nice things about that particular source, and actually the state revolving fund too, is that the agencies who are working with you don't want you to fail. I mean, they're not doing this because they want to foreclose on a property. They're doing this because they want advanced conservation, and they'll be in it with you. And I think that the value of having these agencies, I mean, the Cal EPA, the folks at water boards were wonderful to work with. And I just got off the phone with one of them, and he was talking just about exactly that. I mean, they want this to work, and they'll do a lot to make sure it does.
Well, and that builds, Kristin, you first.
I just have one other thought about preparing the way for your board and staff to feel comfortable with a bridge loan. I'll put in a plug for accreditation, because I do think having the systems in line really increase your confidence level to be able to make sure all your ducks are in a row. I heard a quote recently is that, let's see, you don't rise to the level of your goals, you fall to the level of your systems. And that has made a difference. Our first loan was actually from a bunch of neighbors when we were a volunteer trust, and it was chaotic and hairy and not fun. But our last loan with the food bank farm project with the conservation fund was so easy comparatively because we had our systems up and running.
Yeah, I'll second that.
I was going to say we'd give a +1 to that, but in this case we're just following on Cam's. So interesting point, Cam, that you bring up in terms of an aligned partner, or in some cases an aligned lender. And I want to pick up on that dynamic just a little bit. We've got some questions pouring in the chat, so I'll use moderator privilege for 1 or 2 more panel discussion questions before we open things up. But Reggie, we've often joked, and if I didn't disclose before, once upon a time I was on the investment committee for the loan program at the Conservation Fund. Often joked about Reggie's role as playing the Mr. Monopoly, twirling his mustache and pounding his cane if it helped to incentivize your partners to do something, your donors to do something, but it being probably not much more than a quite convincing act. So I want to talk about real versus perceived risk, especially in terms of repayment strategies. And let's go worst case scenario here. So you, the borrower, you had a plan A, B, C, D, all the way through Z perhaps, but for whatever reason, things did not come through in just the way that you had thought. Perhaps a funder fell through, perhaps it was a donor, perhaps it was a grant source. Reggie, can you talk us through a little bit about, obviously from your perspective in the conservation loan program, but also thinking more broadly about value aligned lending or lenders perhaps, and how that can maybe take just a little bit of that hesitancy, maybe a little bit of that fear out of the equation for folks?
Yeah, and I think preface my comments. I've seen folks asking questions about financing restoration or maybe trail construction, park creation. So things get a little more complicated if the repayment for those activities doesn't quite come through. I mean, usually those are funded through like reimbursement style grants. But let's, Leigh, run with your question on an acquisition, right? There's a land asset in play. I guess it really depends, but with mission aligned lenders, particularly those in conservation with a familiarity, sometimes that's where technical assistance comes into play. Whether it's reaching out to the agency partner, the grant maker, to understand why the project wasn't funded. Maybe there's some tweaks and you just extend the loan a year or 2 and resubmit the application. Another, maybe it's a little bit more apocalyptic than that, We've seen kind of triple fallback. So plan C or D is simply retaining a conservation easement on the property, reserving a home site or two, to control the outcome. So maybe 90% of the project is conserved or 95%, and the rest is developed. But at least the organization is out from under the risk of not being able to repay the loan. So there are a number of different ways, but really, bad news doesn't get better with time. And so when things don't go well, don't be afraid to reach out to the lender to let them know and ask for help and ask, what are the potentials for a loan extension? Or is there any technical assistance? Do you have any ideas? Is there somebody that you can call to help? Engage us because we may be able to help and might be able to actually come through with a great outcome, and we come up with plan D, E, or F that was never previously considered, and the outcome's a success. So hope that answered the question, Leigh.
It did, and I want to dig in a little further. So that's with a value-aligned lending source. What about borrowing from a foundation through a program-related investment, a recoverable grant? Can you comment on how, kind of borrowing from your graph on lending or lenders, the more you get a mission alignment, the better the potential outcomes might be should something go wrong?
Yeah. So first, just to define a program-related investment, that's effectively a loan from a foundation. Foundations typically have to grant, I think it's 5% of their corpus each year. But what's nice about a program-related investment, i.e. a loan, is it helps them count towards that 5%. They may get it back. And usually it's at a very low interest rate, if any interest rate at all. It could be a 0% program-related investment. It could be 1%, what have you. But typically, let's say you have a program-related investment that you might not be able to repay. Maybe you get an extension if there's some mission alignment, or the foundation may be able to simply convert that program-related investment to a grant. It may be. It may strain the relationship in the future with the foundation, but it's something to consider, and it might be an appropriate exit strategy. But I think you want to go into a program-related investment with your favorite foundation with a strong game plan to repay it, and honor the original intent. I don't think you want to go into a program-related investment assuming or thinking that you're going to just get it forgiven. So take that seriously.
Yeah, speaking from my past experience working with Resources Legacy Fund, you got to really be cautious about making any assumptions about their willingness to forgive and turn it into a grant. That's a risk I wouldn't take.
Absolutely. All right, last up before we hinge over into Q&A here. Future trends and what's next. So we hinted at the beginning of a number of emerging sources of debt finance, bridge finance, lending capacity or authority. I can think of a couple examples from the Mid-Atlantic up to New England, if not across the country, but just want to open it up to hear some outlook.
Sure. I'll start. I mentioned it earlier, and I'll kind of break it down. Let's say traditional loans as we think of them, home loan or loan from a bank, loan from a conservation lender. Usually, I'll call it like single source debt, i.e., you've got a $500,000 gap in your funding for a project. You borrow $500,000 from Open Space Institute or us or wherever, and off you go. Because projects are becoming more sophisticated, or becoming pricier, but also organizations are becoming more sophisticated, there's this emerging trend of what I'll call like aggregated debt, i.e. organizations like up in Washington. I just saw an article where Peconic Land Trust on the out on the forks of Long Island. Had, I think it was 6 lines of credit from 6 different individuals or supporters that they used to secure like an $11+ million project. So amazing. And so you just kind of bringing together and stacking up lenders, usually individuals in these instances, impact investors. Sometimes there might be a foundation involved with a program or mission related investment. But that seems to be a growing trend out there. And it's a new and exciting way, I think, that organizations can engage their support network. Folks might not be able to afford giving you a significant gift towards a project, but they might be able to afford lending you some of their money. Another really exciting and I would call it humbling trend is growing number of organizations, as we all think about community conservation, are engaging with their indigenous communities and working with them to help tribes and others regain access and control of ancestral lands. There's a wonderful body up based in the Twin Cities, the Indian Land Tenure Foundation. They actually provide financing to tribes and are interested in potential conservation outcomes there, community forest outcomes and that sort of thing. So there's, I think, a growing partnership. We at the fund, we've provided a few loans to indigenous communities, usually an indigenous run or led nonprofit to help them, again, regain control of ancestral lands. But it's I think a growing and emerging trend. It's pretty exciting, but also incredibly humbling at the same time. So yeah. Go ahead,
and to speak to that repayment source, the beautiful thing working with tribes is that they do benefit from appropriations. And for example, land management, that's a dollar amount that's allocated based upon what they manage. So it's a built-in repayment source in a lot of situations, and especially with the Secretary of the Interior, who she is right now, I'd really encourage folks to reach out to him.
All right, well, thanks for panelists indulging as many of my questions as you did. We're going to open things up. We've got one from Kristin Kirkwood, which I'm assuming is for you, Kristin, panelist. Interested in learning a little bit more about your repayment strategies at Kestrel. Did you always know how you'd pay your debt back?
Yes, or at least had a plan, A, B, and C. I'm definitely a true believer in the multiple options and really being comfortable with sort of your worst case scenario, even if that's D or E. Yeah, so I think all of our loans, just thinking back on each of them, have been tied to a significant public grant source that we knew that the land that we were conserving was eligible for. So in Massachusetts, that's the agricultural preservation restriction program for ag lands. That's the landscape partnership program, which is often for expanding state parks and larger public land areas. It's with municipal funding, Community Preservation Act in our towns. It's with federal agencies. And I think that pairing is really critical because as much as we love our federal partners, we know that they just can't move quickly. And the landowners really don't like to wait for years and years and years. And so the bridge loan has the power of bridging time even more than money to really let the landowner off the hook and move forward directly with the federal agency and the land trust. So I think having clear partners is critical. One of the recent loans we actually did with the Conservation Fund was to buy our headquarters. So we actually bought a house that was on a conservation property. And in that case, we decided to use our unrestricted reserves to pay off the loan when we moved in and created our office. And so in that case, we haven't really paid that one off internally, but I think it's enabled us to think about our balance sheet in terms of our capital assets as well as our cash assets. So tying loans with public funding sources, I think, is key. Or, a project that really has high visibility in the community and has the power to raise significant grant funding or private donations.
Leigh, to flip the question on its head, I think it would be a rare lender to approve a loan where there wasn't a repayment plan in place.
Yeah, and I'll third that. One of the things that's most difficult about the state revolving fund is you've got to, their review of repayment source is independent of the agency, so they contract it out. And those folks, they're mostly looking at point source. I mean, on point source like water facilities, so they're pretty hard. So you got to really have your ducks in a row. And also, to the second, Kristin's point about partnering with folks. I mean, as an executive director, if you've got a receipt source, then it's extraordinarily valuable to you for operations because you can't raise unrestricted money in a lot of different other ways. So, naturally, you're going to be very hesitant, and your board is going to be very hesitant to use your own receipt sources from whatever operation. I mean, maybe you're selling beef or something along those lines for this purpose. But if you're partnering with an agency that can raise money to pay it back, then that's pretty helpful. And I think you're going to find more and more aligned interests like that as we move forward.
Absolutely. And Cam, I want to piggyback. We had another question come through based on your reference of using carbon offset revenue as a repayment source. So can you share for the audience, especially for whom maybe haven't thought about that as a potential use of carbon offset proceeds, can you explain a little more about how that actually worked mechanically?
Yeah, when we did it, so basically the tribe had to make the point to the water board that we're going to make a conservation gain on this, I think it was like 20,000 acres of forest land. That means we're going to do better than Green Diamond Resource Company did. And the problem with that is they still had to make enough money to pay back the loan. So the only way to make the point that we are going to make a conservation gain and still pay back the loan was by the use of subsidizing their receipts with carbon credits. Fortunately, the state of California had a very young protocol at the time on forest carbon receipts, and it's gotten better over time, and it was definitely good enough then to make the case that they could implement a carbon project. The water board required the Yurok tribe to enter into a contract before they would release the money, and the tribe did, and that's how we got it. Carbon markets in general are advancing, and in this environment right now at a pretty unprecedented rate, I think. So what I expect to happen is that you're going to have more protocols applicable to, for example, ag land, soils, regenerative ag, in addition to timber, which provide you with that same sort of essentially subsidy against those revenues lost because you took some activity. So like, normal operation is this, and you're making $1,000 a month off of farming this much. Regenerative ag, or some sort of activity for conservation, brings it down to this. And then in order to subsidize that difference, you're able to use some carbon receipts and put a carbon project on the property, if that makes sense. But that's essentially the way that we were thinking about it with the Yurok tribe, and how I'd be thinking about it now.
Do you remember what the kind of total allocation of the loan repayment was the carbon proceeds?
I'm going to guess that was a really well-placed project, as far as carbon value, because of the redwood, and redwood's just got tremendous carbon value. So I'm going to guess it was, I mean, I'm just taking a 25-30% maybe of the total. I would guess. I mean, that's just out of my, I mean, the tribe would know a lot better than I would.
Absolutely, but substantial.
There's a great article written about this by Beth Rose Middleton, who's here in Davis. I'll see if I can get it out somehow so folks can access it. But it
if
really,
you do a quick search and throw it in the chat,
I think I can do it.
Yeah.
I'll do it right now.
Well, we've got another question. This one comes from Brian Garcia, and I'm a big fan of this question, though, Brian. We may not have all the answers yet. What do the conservation finance community, what do the investors here think about yesterday's announcement from the Department of Agriculture on a new $1 billion available for climate smart communities in the pursuit of expanding markets? Brian, you linked to this announcement. You won't be surprised that we were sharing this around the circuit this morning. I'll wage an uneducated opinion on this one. The question being, how should conservation groups and states think about this opportunity? Immediately when I saw the announcement, Brian, started thinking about a number of both approaches and project activities for different groups across the country who really ought to throw in or consider the kind of funding announcement and funding opportunity for their work, so long as it's relevant. Jackson and I were talking this morning. If you look at the eligibility requirements, our joke was, well, gee, who isn't eligible to apply for these funds based on just a very long list of who would be eligible. So that's just a quick and off the cuff response, but I'm curious, Reggie, perhaps Cam, or even others who are listening in, if you wager a perspective on this announcement from USDA.
Man, hadn't seen the announcement, but love more funding for conservation. Inevitably, there'll probably be a lag, a time lag between award and actual cash, and can landowners wait around? And I'll use the wonderful RCPP program that's out there. There are so many organizations that have been awarded RCPP funds, and they signed the contract 36 months ago or 24 months ago, and they've got landowners on the hook that need to make decisions or need to sell, and the funding isn't there yet. And so, how do we bridge that, so the deals aren't lost, because they've been lined up, they're part of the grant agreement from 3 or 4 years ago, when the thing was submitted, and they're still waiting around. So that's just my pragmatic focus on financing approach.
Yeah, I would definitely echo that. We are part of a consortium of land trusts in the Valley that received $4 million from the RCPP program years ago, and we still haven't been able to spend it. So I think that's the real danger with federal funding. It's great that this administration is throwing money at climate solutions, but the ability to access it is super frustrating. And if there's a way that the National Land Trust community can help our federal partners streamline that process, I think that should be a high priority.
And I saw a comment there. I mean, I'm enthusiastic. Don't get me wrong. Love more funding for conservation. However, go in eyes wide open with your business plan and just a realistic approach. And, getting back to the question on carbon credits, we did a loan years ago where we were being asked to bridge wetland mitigation credits. And lo and behold, the permitting process at the time seemed like it was right there. Credits were about to be released and all that. 3 years later, they still hadn't been released because of leadership changes at the Army Corps of Engineers district or what have you. So again, you know, if you're getting feedback from a grant maker, like, and particularly in the agency world, that it's only going to be 6 months, double the amount of time when you're talking to a lender about how long you think you're going to need the loan, just so you have that cushion in case things go a little bit slower than anticipated.
Yeah, I was going to suggest also that in the SRF context, I'd like to see more people applying for loans before they have the deal. And, you know, if you all work under plans and you know what's in there, and if you submit that in your application process, I wouldn't be surprised if they'd be willing to approve a loan, and then you'd be able to draw from it when the time comes. I haven't seen it done, but I think it would work. Well, actually, there are examples of it being done. I think it's in here. Go ahead.
Yeah, I mean, I think the 1 billion is, you know, definitely will get everyone's attention, but so should the Land and Water Conservation Fund, 900 million, right? And so,
yeah,
we're talking serious federal funding availability, but the speed at which we can access that is the key over the next 5 or 10 years.
Well, and I think this has come up already today among the kind of discussants here as well as in the chat, but with the influx of new sources of funding and financing, and I'll kind of refer to the slated doubling of state revolving fund coffers, I think having that nimbleness, having that, you know, as much readiness as we can instill in our organizations to be accessing these funds or accessing these finance sources is going to be paramount. We still have to land them for conservation just because it's, you know, potentially applicable. Like we're talking, $1 billion will get a lot of attention. Will that translate in the near term to $1 billion on the ground? We'll see. But definitely keeping our knees bent and being as capable as possible for landing these into our operating areas and into the project activities that we need to happen, whether at a local municipal level, perhaps at a state level or regional level. I want to keep moving through just a question or two more here. This came through in the chat, and I think there are some compelling examples to highlight bridge finance or borrowing money for restoration activities, especially. Certainly, you don't have the underlying land basis in many cases through acquisition or easement. Some cases you do, but I'm curious, Reggie, if you could comment on maybe the portfolio of restoration relevant loans that you've granted over the years.
Yeah, thanks, Leigh. You know, I think, you know, it's fascinating. Again, you know, there are an awful lot of reimbursement style grants out there, and it's for restoration, it's for trail construction, it's for whatever, you know, kind of conservation outcome you can imagine. And the grant makers, you know, and they're kind of either one of two styles. Either you spend all the money and then seek reimbursement, and you have to wait 90 days for the reimbursement to come, or you spend as you go and kind of submit monthly or whatever quarterly statements and get reimbursed as you go. But either way, you know, the grant makers, there's so many wonderful organizations out there that are receiving, you know, $5 million reimbursement style grants, and they've got 150 grand in their checking account liquidity. And so how do you make those go? How do you improve the churn? So certainly using borrowed money to do it. You know, no shortage of examples, but, you know, how do you do it? You know, it might be a great fit for a foundation, a program related investment, especially if you've got one of those in your community, because of the outcomes, right? It's conservation, but usually if there's a trail involved, there probably is going to be some sort of economic return and development aspect, you know, more recreational users, you know, impacting the community. So foundations might really get behind that. You know, it's a challenge sometimes with collaterally, as you point out. Some lenders may consider the reimbursement style grant to be sufficient collateral. Others might want some other asset, whether it's land, maybe the property that's being restored, or some other real estate asset. And in other instances, the organizations don't have that luxury or that privilege. And so it's a way for, again, to engage their support network. Is there an individual donor or supporter, or maybe even a past board member that could personally guarantee the loan? Or I saw in one instance, we did a rail trail project, and the steel on the rail was actually the collateral for the loan because it was worth more than $1 million as salvage. So things, getting creative. Christmas tree farms, Christmas trees are inventory. Those are worth something. We use that as collateral for a loan. So, again, getting creative, thinking about, as a business, thinking about the assets in play, particularly conservation assets that might have a monetary value, and can you use those as collateral?
I think that's great, Reg. And I think it cues us up well for, as we round things out here, as we approach 3:30 Eastern, and before we lose folks to other commitments. I'll ask each of our panelists for a very short, less than one sentence, perhaps even, if I can be so bold. What you wish people would walk away from this session with.
I just throw in that, go in, find your state water board and just start inquiring and go after it. I think it's a tremendous opportunity.
And then tell us all about it. That's great.
And tell us all, call me if you need help doing it. I mean, I've been through this with states, so.
Absolutely. Reg, from you?
Man, I wish I had time to prepare a haiku or something, something pithy. I think be creative, not just thinking about financial assets, but also your social capital. That leads to being courageous, as Kristin pointed out, and don't be afraid to wrestle above your weight class.
And look forward to the milk on your whiskers that'll come.
Yeah, and look forward to the milk on your whiskers.
Kristin, on to you.
Yeah, well, I think this goes out mostly to smaller land trusts, but I think the power of thinking about your operation from a financial perspective really can bring with it so many benefits to build momentum and impact in the community. And so don't be afraid to, dig into the Excel sheets and value your time, figure out who your partners are and build the financial plan for each project that leaves you in a better position to do more for the next one.
Absolutely. And with that, I'm going to thank each of you for joining us today, for sharing some of your experience to date on borrowing or lending, as the case may be, some sage wisdom and counsel for folks in the audience, whatever stage they're at in their borrowing or lending trajectory here. I do want to make a quick plug for our next session on March 8th. That is going to be all around corporate engagement and how you successfully sell your project. We're pulling together a pretty exciting session, not only including some corporate and business partner experts who can share with you how to pitch the corporate, but we'll also be joined by a representative from Dr. Bronner's to talk about how they, as a kind of mid-sized corporation, like to be pitched. So please come back in March and please stay healthy, well, and warm in the meantime. Thanks for joining us again today. Thank you especially to Highstead, our partner in this webinar, for helping to make it possible. And we'll let folks on to the next, come back for the recording, and thanks again.
Thank you.
Thank you.
Bye, everybody.
Thank you. Thanks, everyone.
Take care.